Okay, well, welcome to the Rainmaker Institute's webinar for this month. We've got a really special guest in here, Greg, and he's going to share a lot of really important information. And this is, I guess it's 'tis the season, right, Greg? Yeah, kind of makes sense. Well, let me do a quick introduction to Greg, and let me tell you what he's going to be sharing with a little bit about what he's going to be sharing with us today. And it's going to be about tax planning strategies to limit some of your exposure and be more smart with the dollars that you work so hard for. You spend so much money on marketing, so much money and time in the court or paperwork and dealing with clients. And then for them, when you get the success, making sure you're smart with that money, whatever you do, because there's special carve-outs for law firms and with small business owners working in the margins and working and approaching these strategies and tips. I just think it's a genius approach. That's why we wanted to bring Greg back on to share some of this information with us. So if you're not familiar with Greg, good grief, I hope you are after this meeting. But he is the owner of Amicus Settlement Planners. He's an attorney, so he knows what it's like to be in a law firm setting, right? He's also a certified financial planner, so he knows the intricacies in the process of, just like you do with law, right? And so he's really an expert on this because this company he founded in 2006, right? He's past president and board member of Society of Settlement Planners, part of AAJ and other big organizations like that push forward a lot of causes for justice. But ultimately, I don't know, if you were to know Greg, I think you'd probably say his biggest accomplishments, his wife and his family. Right behind you. Where's your law degree? And well, where's the scales of justice? I don't see any of those, Greg. Anyways, well, Greg's a really good guy. I'm going to invite him on here. He's going to share some information with you. Make sure you introduce yourself in chat, your name, your city, and your practice area. We're going to be watching chat. If you've got questions, please pop it in there and we'll get them addressed. Okay? Over to you, Greg. You're on mute.
Okay. Wow. Yeah, I've been responding this whole time. No, yeah.
Okay. Sorry about that.
No, my bad. Let me just share my screen here. And we'll kind of get into the presentation. But yeah, thank you, Philip, for that introduction, for having me on to kind of talk about some of these tax saving strategies for attorneys. Our firm works almost exclusively with attorneys and their clients. So this is really our area of expertise. And really our even more narrow focus is working with plaintiffs and plaintiff attorneys. So a lot of these strategies will be helpful for any kind of practice that we go through. And we'll kind of talk about lots of different ways to save on taxes. But towards the end, we'll talk about some unique ways specific to contingency fee-based attorneys that they can utilize to really save themselves a lot of money in taxes. So we'll just get started. A little introduction. I know, Philip, you kind of introduced me already, but just so people kind of know who we are and how we can help them. So we started this firm in 2004. It's already been 20 years. Most of us are attorneys and certified financial planners. We also have a CPA that's going to be coming on in a month. We have a CFA. And so our focus, like I said, is on plaintiff attorneys mostly and plaintiffs themselves. But we also do some consulting with just law firms in general in terms of how to save them taxes. So our main areas of focus are structured settlement annuities. So if you're a plaintiff attorney, you've likely dealt with structured annuities for your clients. We do structured annuities for clients all over the country, for plaintiffs and for attorneys. And we'll get into that a little bit. We're a registered investment advisory firm through Amicus Financial Advisors, so we can invest funds for clients as well. Installment sales is something we're going to be talking about as well, which a lot of attorneys may or may not have heard of. We'll get into what those are. And then we do a lot of trusts for minors. So if you have a minor's case and a structured annuity doesn't make sense, we can help you set up a trust. If you have a client that's receiving, needs-based government benefits like Medicaid or SSI, we can help you set up a special needs trust for them. and kind of consult with you to know when you need that type of trust planning for your client, when you don't. So that's the government benefits planning. And then the focus of this presentation will be on the attorney income tax planning. So today, what we're hoping to cover is just kind of outlining the most common strategies that attorneys can use, regardless of the type of practice area that you're in, whether you're contingency fee-based, hourly, or whatever. And then at the end, we'll talk about some unique tax planning strategies that are only available for contingency fee-based cases. So again, this is all just informational. I just like to give a little disclaimer. When we go through these, you'll kind of see, okay, that may make sense for my firm. This one might make sense for my firm. What you're going to want to do is get with your own CPA or your own tax professional and just decide, okay, which one of these makes the most sense for my unique situation. And so the goal here is just to give you kind of general information that you can then take and kind of specify and particularize for your particular firm. So let's get into the different options. So we like to call it save it, spend it, deduct it, stretch it out, or defer it. So we'll kind of go through these different ways you can save money. Of course, the first way you can save money on taxes is by saving it in various types of retirement planning options that we'll go through. So the Internal Revenue Code has various incentives for people to save for retirement so that we're not solely reliant on Social Security. And so they give us a tax break for investing in some of these retirement plans, and we'll talk about that. The other options you have are to spend it. A lot of you are probably familiar with the Section 179 deduction. So for office expenses, for certain types of vehicles, for case expenses, for lead generation or buying cases for the future years. So sometimes spending money in a current year is a great way to reduce your taxes because it's an expense that you can deduct. We'll talk about other deductions. One in particular we'll go over is called the qualified business income deduction. And then another way to save taxes is just by stretching it out sometimes. And we'll talk about that in terms of the installment sales that we talk about. And then defer it. So we'll talk about attorney fee deferral options as well. So we'll get into the most basic or the most common retirement plans that are out there for really any type of business, not necessarily just law firms, but the most common options that you will see are 401ks, a defined benefit or pension plan, what we call a simple IRA, a SEP IRA, and then we'll talk about IRAs, just general IRAs and Roth IRAs. Let's see, looks like I thought there was a question, but let's see. Okay, so 401ks. So with a
Right, there was. I got it. I handled it.
Okay, yeah, you're on top of it. Good. All right. So with a 401k, the 401k can be set up for your firm. The employees can contribute up to $23,000 per year. If they're over the age of 50, then they can contribute up to $30,000, $30,500 per year. So as they're closer to retirement, most of these plans give people a little extra room or a little extra that they can contribute towards their retirement. So the max employee and employer contribution combined is $69,000. And all of these numbers are 2024 numbers, okay? So with a 401k, you have a little bit more discretion in terms of how much you weight towards owners of the firm versus employees of the firm. But with all of these qualified plans, we call them, and if it's a qualified plan, it just means that it has a specific designation or kind of section in the tax code that outlines the rules. For all of these types of plans, you do have to include everybody in your firm if they have worked for you for at least a year. That's the general rule. So you can't just do it for the owners. You do have to include everybody in the firm. So it's a commitment that you're making as a business owner or a law firm owner to everyone in your firm. But so that's one of the things you'll want to keep in kind of the back of your mind as you decide which option's best for you. But So the max combined employee and employer contribution limit is $69,000 per employee. And then, as I mentioned, that formula can vary between the classes of participants, owners and non-owners of your firm. And then there is some interesting kind of Roth and after-tax options that we're not really going to get into in this presentation, but that are kind of interesting if you want to go down that road. The next most common type of plan, or not most common type, but another very common plan is what we call a defined benefit or pension plan. And these are very kind of law firm or business specific. So the plan administrator that administers these plans will go in, look at your company, determine what makes the most sense, and then come up with a plan document that will come up with most of these rules specific to your firm. But with the defined benefit plan, the nice thing about these is that the minimum funding requirements can be very high. And then once you're locked in, you do have to make sure that you're funding that minimum amount every year. And so before you commit to one of these plans, you want to make sure that once you, or as you do it, you're going to be able to fund that minimum amount every single year. With this type of plan, like the 401k plan, the formula for employees versus owners can be different. So this one has a little bit more flexibility in how you set it up for your particular firm. But the benefit here is that you can contribute pretty substantial amounts to the plan. And we'll go through an example maybe here in a little bit. Now we get into kind of some of the more defined plans that are simpler to establish, maybe less expensive to establish, but have less flexibility. So one is called the simple IRA. So that's a simple individual retirement account for your business or your firm. This one allows up to $16,000 per year that the employee can contribute. If they're over age 50, then it bumps it up to $19,500. And then the employer can match that, but the total combined contribution amount between employer and employee cannot exceed $32,000 unless you're over 50, and then it goes up to $39,000. With this one, there's a 3% matching contribution from the firm for all participants. So that's what you're looking at as a law firm owner. If you want to set up a simple IRA, know that you've got to include everyone in the firm that's been there for more than a year, and then you can match up to 3% of the employee's contribution limit or their salary or whatever that parameter is. So for example, in order for someone to get up to 32,000, well, I'm sorry, I'm going to do that on the next one. But that's a simple IRA is exactly what it sounds like. It's simple, it's easy, and it's easy to implement, and it's pretty straightforward. With a SEP IRA, the employer can contribute a little bit more, up to $69,000. With a SEP IRA, only the employer makes contributions. So the employee does not make contributions to a SEP IRA. And the employer can contribute up to 25% of the employee income. So this allows for higher contribution limits for your employees. If you've got some really superstar employees that you want to keep, or some younger, associates in the firm, a SEP can be a good way to do that because it incentivizes them to stay with a larger amount. It does have to be the same percentage to all employees, however, so you can't just favor one associate over another. You do have to be uniform across the board. And so this one can be fairly expensive as an employer, as an owner, in setting this type of plan up. This is just an example for a law firm that we worked with. We changed the name, where they were trying to decide which type of plan made the most sense for them based on their unique situation. And so we just kind of went through 3 different scenarios of the SEP, the simple, and the defined benefit plan. And in this situation, they went with the defined benefit plan with a 401k because it allowed them, the owners, to contribute more and get a larger tax deduction themselves than the other options allowed for them to do. So if you really want, to decide, help deciding which one makes the most sense, we can certainly help you do that, or your CPA or other professional can help you kind of make those decisions through this similar type of analysis. And then finally, most of you have likely heard of just a traditional IRA or a Roth IRA. So for 2024, that contribution amount per individual is $7,000, unless you're over 50, and then it's $8,000. You can establish that by April 15th of the following year. So you still have time to contribute to 2023's traditional or Roth IRA. The difference between a Roth and a traditional IRA, you're using pre-tax money, and so you get a tax deduction for it. And so essentially it's pre-tax money that's being put into the IRA. You haven't been taxed on that money yet. And it grows on a tax deferred basis like all of these plans do until you take them out, take the funds out. With a Roth IRA, you put in after-tax money that you've already paid tax on, and it grows tax deferred. And then actually when you take it out, it's also tax-free. So a Roth IRA, especially for, your kids or your younger employees who are already in a low tax bracket, a Roth IRA sometimes is a great idea, because even though they're putting in after-tax money, they're not getting the current year tax deduction for that contribution. Because it all grows essentially tax-free in a Roth IRA, that can really be a powerful thing. So a lot of your employees or you even may not even have a retirement plan at work. So you can always, any individual can participate in either a traditional or a Roth IRA. So the Roth IRA does have a contribution in terms, an income max. In other words, if you are making more than $230,000 married filing jointly, then the Roth IRA starts to not become an option for you. There's a phase out period till about 240,000 in modified adjusted gross income. But if you're well above that, the Roth IRA is not an option for you anymore, unfortunately. Let's see. So again, we're not getting into the specifics of how to set these up, but this was just kind of a bird's eye view of what retirement plan options there are for you to set up for your firm. So just as a summary, the 401k allows for higher contribution limits. It's a little bit more flexible in terms of owners versus employees. The defined benefit plan or the pension plan can have some pretty high limits, but it does have mandatory minimum annual contributions from the firm. And so if you have a down year, you still have to contribute the minimum contribution amount, and that can be kind of a scary thing. The simple IRA, moderate limits, there's that 3% matching contribution across the board for all employees. The SEP IRA has a little bit higher limits, but you've got to do equal percentage for everybody in the firm. And then Roth and a normal IRA, that's regardless of whether you're part of a firm or not, you can set one of those up. Those have fairly low limits, $7,000 per year, but there's really, it's not dependent on you being part of a plan through your employer. So we are going to, I think probably the most valuable thing that we will send you is this retirement plan comparison chart. And you can go to this website that we've created and download this chart. It's amicusplanners.com/2024. And you can go ahead and download this chart. And this is just a nice way to be able to view all of the more common plans, what the contribution limits are, the vesting schedules, the setup deadlines, all of the things kind of in one shot. And so if you're a little bit overwhelmed as to all the things that we just went through, this is a great chart that you can reference. So those are kind of the retirement plans, which is kind of the save it way to save money on taxes. You want to put money into a retirement plan, get that tax deduction in the current year, let the funds grow, tax deferred until you take it out. So obviously the idea with a retirement plan is you're getting a current year tax deduction for whatever you put into the plan, and that's what saves you on taxes currently. So the next option that I'm sure many of you know about is the spend it option. So with this option,
sorry, I don't have an answer for that.
Oh, Alexa doesn't have an answer for that. Sorry. But essentially with this option, you can prepay your expenses. So if you know that you're going to buy a new type of contact management software, so if you're going to transition from Needles to, Filevine or something, that's a big chunk of money. That's obviously an expense that you can deduct. And so a lot of firms will do that towards the end of the year. They'll buy software, they'll prepay rent sometimes. Advertising, I know with plaintiff attorneys, if they have a lead vendor that they like to use, they'll put a bunch of money with a lead vendor or buy cases or whatever the case may be to kind of get some expenses that they can deduct on their current year tax return so that it saves them on taxes. They're essentially prepaying for those advertising expenses. The 179 deduction allows you to take a current year tax deduction for up to $1.22 million for things like furniture, office expenses, computers, even some vehicles. If it's used, primarily in the course of your business and it meets other, requirements, you can deduct certain vehicle expenses with the 179 deduction. So, these things have to be done in the same tax year. This isn't something you can wait until April 15th of the following year to do. So towards the end of the year, if you're going to use the spend it option to reduce your taxes, just remember you need to do it before the end of the year. So, all right, let's talk about the qualified business income deduction. So this is somewhat new. It's in section 199A of the tax code, but essentially it allows for a 20% deduction on your qualified business income. So let's just go through a little example of what that means. So if your total taxable income, assuming you married filing jointly, is below $383,900, and you get $150,000 as a salary, say you're set up as an S corp, you get a salary of $150,000, and then you have $200,000 in kind of bonus income, that means that your taxable income is $350,000. So $150,000 as your salary, maybe through a W-2, and then you have $200,000 in bonuses. So now you're at $350,000 in taxable income. Then the qualified business income deduction, you're able to take 20% deduction off of that business income, not off the salary portion, but off the business income portion. So in this example, that would be a 20% deduction off of that $200,000. And so that's a deduction of another $40,000. And so I'm assuming that if you use a CPA to do your taxes, they're already all over this and they're already taking that into account. But it's a really unique type of, business deduction that if you can somehow get your total taxable income to below that level through, retirement plan contributions or prepaying expenses or by deferring fees, like we'll talk about if you're a contingency fee-based attorney, then it may be worth getting it to that level so that you can get this extra 20% deduction with the qualified business income deduction. We wrote an article, excuse me, we wrote an article in the Utah Trial Journal in the spring of 2019 that you can access that kind of goes through a few examples and gives a little bit more detail. You can find that at amicusplanners.com/QBI if you're interested. So installment sales is probably a little bit less common, but it's one thing we just wanted to touch on because a lot of you may represent business owners, or if you live in California, and you have not just California, but that's where most of these come from, and you have a really highly appreciated piece of real estate, and you're nervous that you're feeling tax trapped in that piece of real estate because if you sell it, you're going to have a huge capital gain and pay taxes on that capital gain. An installment sale for a business or a highly appreciated piece of property just allows you to take that income from that sale of that property or business over time rather than all in the same tax year. And so the benefit of that is by taking it over several tax years, you lower the marginal tax bracket that you're in when those future payments are taxed to you. So if we take it all in 1 year, then the taxes on that business sale are going to be about $300,000 in this example. That means you have about $696,000 left. If you spread that out over 4 years, the taxes due in the current year go from 303 down to 236,000, right? So that increases your after tax proceeds from 696 up to 774. So you've saved $78,000 by spreading it out for 4 years. And then in this example, if you spread it out over 10 years, then you can see that the benefit tax-wise from you spreading out the sale over 10 years is about $175,000. And so this works really well in situations where you're working with a client and they have done a 1031 exchange on a piece of property maybe, and now they've got this piece of property that's worth several $1,000,000. They want to sell it, and they don't necessarily want to move that into another property. They want to just retire and be done. What you can do is you can fund that installment sale with a structured settlement annuity. So that way there's an annuity company that's making future payments to the seller over time, and the seller is only, I'm sorry, to the seller, yes. And so the seller is receiving payments from the annuity over time and only paying taxes on the amount that they're receiving from the annuity each year, rather than paying a higher chunk from the sale of that business or property in the year they sell it. So MetLife is probably the leading annuity company that does these types of installment sales. And so if you get to the point in your own business and you want to sell it, but you don't want to pay taxes on it, or if you have a highly appreciated piece of real estate, or if one of your clients comes to you with something like this, just keep this in mind. This is a really great way to guarantee future income, reduce taxes on the sale of that business or property, and go from there. And then the nice thing about the annuity is that the seller is not then worried about the new owner of that business making those future payments each year. They have an annuity policy from MetLife to guarantee those future payments. So hopefully that makes sense.
Hey, Greg, we got a quick question
Yeah.
that came in here. Let me just pop in with it. The back to the QBI deduction, is that available to sole proprietors or just corporations?
I believe it's available to sole proprietors as well. Yeah. As long as it's your business and it's business income. I don't think that the business entity necessarily matters, but
Okay.
yeah.
Oh, great. Thanks.
Yep. So those are kind of the more, regardless of the type of attorney or the type of cases you get, those are kind of the common ways you can reduce some taxes. This next part's going to be unique to contingency fee-based cases. So even if you're an hourly based attorney and you get an occasional PI case and it's based on a contingency fee, this applies to you. So for contingency fee-based attorneys, you have the unique ability to defer the receipt of the income on those contingent fees to future tax years. So that allows you to postpone the tax obligation until the year you receive it. So becomes a very powerful way for you to really manage the amount of you pay in taxes from year to year, because you're not recognizing income on cases that you settle this year until you receive the income from those cases in the future. And so we'll talk about a couple of different ways that you can do this. And one is through a structured settlement annuity, and the other option is through just a deferred compensation plan. So let's go through each of these and we'll kind of explain the pros and cons of each option. So if you're a personal injury attorney, you've probably done a structured settlement annuity for your client where the defense casualty company that you're settling with, they send the portion going to the annuity directly to the annuity company. The annuity company then creates an annuity policy that pays out to your client over time. And so essentially the same thing can happen with your fee. If you don't want to receive that fee in the current year that you settle the case, because you're then going to have to pay taxes on that fee, you can do an annuity just like your clients do. And decide when you want those future payments paying to you in the future. And then just like with your clients, there's language that goes into the settlement agreement and release between the parties that outlines when you're going to receive those payments in the future. So at the time of settlement, you have to decide, okay, I don't want to receive this $100,000 fee, for example. I want to defer it in this annuity to pay me out when I retire at age 65. And so we would help you run those illustrations, and then you would have language in the release agreement that specifies when those payments are going to be made. And then that $100,000 would go directly from the defendant's insurer to the annuity company. You'd get an annuity policy that shows when you're going to be receiving those future payments. So just like you do it for your clients, the only difference is for your clients, if it's a personal injury case, all of the interest that's earned inside of the annuity along the way is totally tax exempt. Whereas for an attorney's fee, it's tax deferred, meaning the growth isn't taxed along the way, but once it's paid to you, at that point, you are going to pay taxes on it. So I got a question from here. Deferral of income may be at a much higher tax rate in the future. How do you factor that? So that's a good question. So with the annuity, when you're setting up the annuity and you're deferring it to future tax years, you don't know what the tax rates are going to be when you receive those fees in the future. If you're not working, a lot of attorneys will just defer it to when they want to retire. So if they retire at age 65, they know they're not going to be having that income coming in. They're assuming they're going to be in a much lower tax bracket at that time. And so that's how they're, kind of factoring that in. But most attorneys, when in their working years, are going to be in a much higher tax bracket than when they retire. And so that's the idea. The other really nice thing about structured settlement annuity deferrals is that you can create like a lifetime guaranteed income stream for yourself. So a lot of attorneys will say, I want to start an annuity deferral at age 65. I want to include my spouse, and I want it to pay out for as long as we're both alive, with a minimum guarantee period of like 20 years. So that way they know that they're going to have income coming in until both, the attorney himself or herself and their spouse has passed away. So they guarantee themselves lifetime guaranteed income through the annuity. And they'll just pay taxes on that as it comes into them every year. So that's the structured settlement annuity option. Here's some benefits of that I may have mentioned a little bit already, but a benefit of the structured annuity option is that you have a fixed guaranteed rate of return from a very large insurance company like MetLife, Pacific Life, Berkshire Hathaway, New York Life. So it's a very conservative, very safe investment in terms of, exactly what your rate of return is going to be, exactly what the payment's going to be, when it's going to pay, and all of that. And there's no ongoing management fees or anything like that. So it's very simple, very basic, very safe. They're very flexible and customizable at the time that they're established. So at the time that the settlement is being worked out, we can work with you to really design that annuity to meet your needs and goals as much as possible, for as possible as it is to look into the future and know what your needs and goals are going to be. You can do that. They are not correlated to the financial markets. You get the rate of return you get. Right now, annuities, the rates of return are better than they've been in the past. For many, many years when interest rates were super low, annuity rates were also very low. And so they were a little bit less attractive. Now we're seeing annuity interest rates, guaranteed annuity interest rates in the 4.5%, even 5% range. And so if you can guarantee, a lifetime 5% rate of return, for depending on your situation, that's not terrible. And then, like I said, it's guaranteed by very large, very well-funded insurance companies. So some of the disadvantages of annuity-based deferrals is the returns are, because it's a guaranteed rate of return, It's probably less than you're going to be able to average in the market over time. But again, it is guaranteed, but it's likely going to be a little bit lower. It is inflexible once you've established. So we like to talk about these annuities like laying concrete. So when you're laying concrete, it's very flexible. You can do a lot of different things with it. But once it sets, it's set. So once you've decided on that annuity payout design and it's in the release agreement and you have that annuity contract, it's pretty inflexible. You can't really change it. The only way you can access that money is by going to a factoring company. And you've probably seen the commercials late at night where they're singing about, it's my money and I want it now. Never call them, but you do need to go to one of those types of companies if you did need to access the money in one of these annuity-based fee deferrals. So they are inflexible once you've established them. And then, like I said, the distribution timing, the payments as they come in can't be changed along the way. So, and I kind of mentioned that before. So that's kind of the annuity-based fee deferral option. Depending on people's risk tolerance, where they're at in their career, whether they want a fixed payment or not, really depends on which of these options they prefer. Seems like the closer people get to retirement and they don't have as much time and they don't want to take as much risk in the markets, they're more drawn to the annuity-based deferral because it's fixed. They know exactly what they're getting. It's with a big, strong insurance company, that kind of thing. So now we'll go to option 2 for contingency fee-based income deferrals. And this is just a deferred compensation plan. So under this option, essentially what you're doing is you're establishing a deferred compensation plan with a plan administrator, okay? And this plan administrator, before you, these plan administrators are similar to like a 401k plan administrator. Essentially what you do is you establish a plan with the plan administrator. Then as you settle cases, before your client signs the settlement agreement on a particular case, you will make an election to defer whatever portion of your fee you'd like to defer on that particular case with the plan administrator. And then when the case settles, the funds can go either directly from the defendant to the plan administrator, or they can flow through your firm's IOLTA account, and then you fund your deferred comp plan from there. And you're not taxed on the amount that you send onto your deferred comp plan. Once it's with the deferred comp plan administrator, then generally they have, a list of 20 or 25 different index funds that you can invest in within the plan. And so you can be as aggressive or as conservative with the investments inside of the plan as you'd like to be. And so over time, if you're a younger, attorney, you have more time for that to grow and you can ride out some of the ups and downs in the market. It usually makes a little bit more sense in terms of a rate of return perspective to do one of these plans. Let's see, we'll probably go through some of the advantages here, but the advantages of the deferred compensation, they're invested in an investment portfolio of your choosing, so you're not stuck with a guaranteed annuity. The deferred fees, they earn market-based returns. There is fixed rate options as well, and you can even just keep it in a money market account if you'd like. It can be direct funded from your IOLTA account. The defense doesn't have to have anything to do with this, whereas with the annuity, there is language that needs to be in the release agreement between the parties. For this option, you don't necessarily have to have it go directly from the defendant to directly to the plan administrator. It can flow through your IOLTA account if you've made an irrevocable election to defer. So there's a question about the 2022 GLAM, it's a general legal advice memo that was issued by the IRS that gave kind of a uniquely aggressive kind of hypothetical example of a deferral arrangement, and then they said that it wouldn't work. So I'm happy to send you the GLAM and send you kind of the several tax attorneys' responses to the GLAM that have been published. and put out there by these plan administrators and their tax attorneys. And so since the GLAM, as long as you're following certain rules, I think most tax attorneys agree that you're still okay to do it. But again, that's going to be up to you and your tax counsel and your level of tax risk in terms of whether you want to do it or not. So, and in terms of likelihood of being audited, I don't think that by setting up one of these plans, it increases your chance of being audited necessarily, because you're still just reporting on your personal tax return the amount that you make in that current year. So if a fee comes in, goes directly to the plan, it's not like you're on your tax return, you're recognizing the income and then taking a deduction. And that's what usually will be a red flag to the IRS as a big deduction. You're not recognizing that income as income until it comes back to you from the plan administrator. And so I'm happy to talk to, individuals about that particular, aspect of this in terms of, the tax reporting and kind of all of those things, if you have questions. But it's a good question. But back to the advantages of the deferred compensation plans, they're a little bit more flexible just because the funds go into the plan. And then for most of them, they have what they call the 1 year, 5-year rule in terms of how you receive money back from the plan. So the 1 year part of that rule just means you generally always have to give the plan administrator at least 1 year's notice before you start to receive anything back from the plan. So there's a 1 year notice requirement. And then the 5 years just means that the fastest you can get all of your money back on a particular deferral is over a 5-year period, and they generally pay that quarterly. So there's different things we can talk about in terms of how you set it up in terms of when you want it to get paid back to you. But if you're not sure when you want to get the money back and you just want to defer money into a plan, then you can do that with the deferred comp option and let it grow until you're ready to start receiving it. Whereas with the annuity option, you have to decide at the time of settlement exactly when you want it back and how much you're going to get back at that time. Let's see. Okay, disadvantages of the deferred comp option. So, of course, the disadvantages are that the returns are not necessarily guaranteed like they are with the annuity option. With the annuity option, you know exactly what you're getting and when. With these, it's going to depend on how the investments inside of your investment portfolio do. And then the other thing with these, you do need to remember that the election to defer whatever portion of your contingency fee you want to defer on that particular case, that is done before a settlement agreement is signed. So you need to make the election to defer with the plan administrator before the underlying release agreement is signed. So while you're still employed by that client, while you're still working on their case, you need to make that deferral. So you can settle the case like at mediation, figure out what your fee is, and then make the fee deferral election with the plan administrator. But don't let your client sign the fee or sign the settlement agreement until you've made that election. And again, I'm happy to get on a phone call with any of you and kind of walk through some of these specifics about the deferred compensation plan in more detail. Here's just a little chart that talks about the differences between the two options, and if you're trying to decide which one may make more sense to you. Let's see. So question, do banks report to any government agencies or to the state bar organizations large balance transfers from your IULTA accounts to deferred compensation plans? Not that I know of. I haven't heard of that, but I'm not sure. There may be certain state bars that do that. That's not something I've heard of.
Let me ask you this question, Greg.
Yeah.
And not to put you on the spot, but how many law firms do you think that are in this process and doing this right now?
Yeah. I mean,
Back of the envelope number.
yeah, we've worked with a couple hundred different law firms. I'm looking over at my partner here. It's telling me the number. Yeah. At least a couple hundred firms have these types of plans set up that we've worked with. I'm sure the plan administrators have, many, many more that have come from different sources. But in terms of just client law firms that we work with to kind of help them establish these plans, it's well over 200. So it's not like it's an unknown thing. They're happening all the time. So
So of those that you have worked with, how many of those had ever been audited or
Yeah.
had to deal with the state bar or any type of regulatory compliance answering?
Yeah, I've never heard of anything with this, any state bar. There have been firms that have been audited just as a matter of course. And so far, there have been no audit exceptions for any firms that have these plans. And so the plan administrators are also very willing to get on phone calls and talk through all of these kinds of questions with individual attorneys about some of these, tax risks or perceived tax risks. Yeah, it's a good question. The cost of setting it up, there's no fee to establish a deferred compensation plan. The way they charge is they charge 1% per year of the balance that's in the plan. So what happens is the funds from the IL to go to the plan administrator's trustee and custodian, which is generally Bank of New York Mellon. So Bank of New York Mellon is the trustee and custodian. That's where the funds go. The trust account is established there. The plan administrator just kind of runs the program. From Bank of New York Mellon, they then invest in whatever investments the attorney chooses. And then that's where it stays. So they're not sending money to us. They're not sending money to the plan administrator directly. It's all going in trust to Bank of New York Mellon. Bank of New York Mellon is the largest trustee and custodian in the world. So and from a flow of funds standpoint, that's kind of how it works. But generally, yeah, it's a 1% annual fee on the balance in the account. And they bill that 1/12 of 1% per month. That's how that's billed. So if you do contingency fee work, there are numerous advantages of using a deferred fee option over like a 401k or the other traditional options. Really, it's this, that you can control the amount of income that you recognize in any year. So as I talked about earlier, that allows you to get under that QBI income limit if you can live on 383 or less. Then that allows you to also take advantage of that extra 20% deduction that the QBI offers you. The other benefits of these plans is you don't have to start taking funds at age 72 or 73 with a required minimum distribution. You can let it grow well beyond those 72 or 73. And you can take funds before age 59 and a half as well, which are nice benefits. And so a lot of times, firms will want to just kind of take care of the next 2 or 3 years of expenses and kind of take a big fee and spread it out over the next 3 years to make sure they have enough to cover their overhead and just take a lot of pressure off. And so the deferred fee option, whether it's through an annuity or through a deferred comp plan, is a really great way to do that. And we can talk about some ways to do that if that's more of your goal, rather than pushing it off way into retirement. If you just want to spread out a really big case over the next 4 or 5 years and kind of take some pressure off and cover overhead, it's a great way to do that as well. The other big thing is, as we talked about with some of these qualified plans, you generally have to involve everybody in your firm. And that's, it's a nice benefit to give to those employees. But in this situation, you don't have to involve employees at all. This can be attorney by attorney in terms of how much you want to contribute on a per case basis. So the only thing you need to remember, again, with the deferred comp plan option or the annuity option, is that it has to be done on a case by case basis. Whereas with the 401k, you can wait until the end of the year, ideally, and then, fund your 401k or your IRA or something like that. With this, it has to be done as each case settles. And so sometimes firms will just do it on larger cases. We have some firms that will do as a matter of course, hey, I'm going to defer 15% of every single case that I settle. I'm going to put into my deferred comp account as a way of kind of disciplining myself to make sure that I'm funding my retirement. So you can get really creative with these different mixes of tax planning options. A question, is there a minimum amount to set up a deferred comp plan? There's really no minimum. There's no maximum. There's no fee to establish the plan. Once your plan's established, you can fund it with there's really no minimum. Like I said, we have some clients that will just like 10% of every single settlement they send to the plan. So they're sending in very small checks. Let's see, another question. What happens to funds in deferred comp plans should you unexpectedly pass away? Yep. So you'll name a beneficiary, just like you would with any other investment account. Those beneficiaries have the same rights that you did in that plan. So depending on the type of distribution option back to you from the plan that you chose, your beneficiary will have to live by those same rules, essentially. But yeah, you'll name a beneficiary or beneficiaries if you have, multiple, and they'll just kind of step into your shoes and assume the same rights that you had. So.
Hey, Greg, there was a question in chat that goes back a few steps that I think that we missed from Peter. He asks, is there anything that prohibits someone from setting up both a simple IRA and a Roth IRA to make contributions to both? I do that.
I don't know if that's 7,000. I should know that. I don't know if that $7,000 limitation on the Roth also is a combo between the Roth and the IRA, or if that 7,000 is a hard cap on both, but I can certainly get you that answer. That's an easy question that I should know the answer to, but I just don't off the top of my head. But well, I'm not even going to say because I'm not sure, but I can get you that answer, Peter. Let's see. So in terms of getting started, so for the annuity, if you're a contingency fee-based attorney, you like the annuity idea. Just before the settlement agreement's reached, we need to just make sure that we have gone through the process of creating the annuity that you like and getting the language into the release agreement, getting the defendant the language they'll need, kind of coordinating with the defendant. With the deferred comp plan, you just need to make sure that you have made an irrevocable election to defer whatever portion of your fee you're going to defer on that case before your client signs the final release agreement. So that's what you need to do. And to get started, it takes, 20 minutes online with the plan administrator to get your plan established. And then for each case where you'd like to establish or where you'd like to defer a fee, there's one other form that you'll sign that lists the name of the case, the percentage of your fee you want to defer, and then you'll just sign and date that. And then as long as that's dated before the release agreement, then you're okay. And then there is also some language that you'll want to put into your retainer agreement between you and your client. And so we can send you that language, but for cases that you have not yet signed up, we'll send you some language that you can put into your template retainer agreement that just gives you the ability to defer your fees on their particular case if you want to. For cases that you've already signed up and have a signed retainer agreement on, we have some language we can send you where you can amend your current fee agreement to allow you to defer fees on that particular case. And then, yeah, even if you don't have a case right now, you can go ahead and set up your plan so that when you do have a case, it's ready to go. This is just kind of what we like to do for attorneys if they're looking into, setting up one of these plans and they're wondering, okay, well, how much is it really going to save me? We do these kind of pro forma projections all the time for attorneys where we can just talk to you about, okay, and of course we like to use big numbers on these sample, on these sample ones, but it doesn't have to be $1 million fee. It can be any fee, as we talked about. There's no minimum, but we can kind of go through with you and decide, okay, how much do you need to bring in each year in your firm or for you personally to kind of run your firm or pay your portion of the overhead, and then personally, like, take home as much as you need to live the lifestyle you want to live. And then above that, really, you should be deferring into a plan, because everything above that is just excess taxation, and allowing that extra income you're earning every year, that gross amount, to go into your plan and be generating income and growth on a tax deferred basis. And so we love putting together these kind of pro formas so that you can see the numbers and see, wow, I could really be saving a lot of money and really building wealth in a really tax smart way. Especially, again, and if you're a contingency fee-based attorney. So just one new thing that we'll touch on really briefly. There is now a way to combine fee deferrals and kind of an executive benefit plan. So essentially what you're doing, you're combining deferred fees with what we call an executive benefit plan using split dollar insurance, which converts taxable contingency fee income into tax-free revenue, with the bonus of a significant death benefit. So we can talk about the specifics because it's more detailed than we want to go into here, but essentially you're getting income from your fee deferral coming in. That income is then funding this split dollar insurance. And so you have a deduction from your business on the amount coming in that matches the amount going to the split dollar insurance, which is growing cash value along the way. And then after a while, of course, with these types of insurance products, you have a death benefit, and then you have a cash value that's built up that you can borrow from. And when you borrow money from a cash value life insurance policy, it's not taxable. So it's just a really interesting, creative way, if you're in the right, if you're in the right, if it works for you to do that. So we kind of talked about this. I kind of went through this already, but you do have to be in somewhat good health, because there is an insurance policy component to this. And then you do have to make, you have to have higher income, about $500,000 in annual income, and have assets of at least $1 million to kind of qualify for this. But it's just using a very well-established split dollar life insurance approach and combining it with this deferred fee option to turn the deferred fees into tax-free income through the insurance product. So I'd love to talk to you about this one. It's really fascinating and really interesting if you kind of check the box and you fit within those parameters. So for deferred comp plans, are there any withdrawal restrictions? Yeah, so the withdrawal restrictions, depending on the option that you choose at the time you set up the plan, there's really two options for distributions back to you. So the first one is you can decide exactly when you want to receive the money back from the deferred comp plan at the time you make the deferral into the plan. So if you're wanting to just spread money out over the next 3 or 4 years, you can do that. That option is irrevocable. You can't change it. With the other option, where you're not sure when you're going to want the money back, you defer it into the plan. It grows on a tax deferred basis. And then once you want to start receiving payments, that's when you give the plan administrator 1 year's notice. And then after that notice, then they can start paying you quarterly payments over the next 5 years. That's the 1 year, 5 year rule we talked about. So that's kind of how the withdrawals work. But you can't, with these options, you can't just call the plan administrator and say, like, hey, I want half of my money. I need it. Something came up. That option doesn't exist. And so that's why I think it's a good idea to have both like a 401k and one of these types of options, so that if you did get into that situation, you can go to the 401k and access the funds immediately, even though there may be a bit of a penalty to do that. Whereas with the deferred comp plan, you really don't have that option. So that's one thing you need to keep in mind. So Phil asks, are you saying that the person never is paying taxes on that revenue? On this strategy, that's what happens is the deferred income comes into your firm like on an annual basis. Those annual payments are matched up with the premiums that are owed on the split dollar life insurance. And so you have a deduction that you take at the business level here. So you're not paying taxes on them as they come in from the annuity. As they go into the split dollar life insurance policy and grow tax deferred inside of that policy, then as you take the income from that as a loan or whatever, then that does become then tax free. And so that's kind of the why that's kind of a unique option. So yeah, that one
really
is unique
Yeah.
that way. Yeah.
I like that one. That's pretty interesting to me. Well, we're at the top of the hour. We've got a quick poll that we wanted to pop up here. So, Greg, really appreciate this information. You know, even though people may think that maybe some of these numbers are and this topic is not the most exciting, this is the things that you're doing for clients are really interesting. And I think it really helps the small business owner. So we wanted to pop up a quick poll here to see if anybody wanted to get a little bit more information, because I know the longer that you were talking, the more details and the more strategies, then a whole nother slew of questions came up, right? So there's and there are a lot of things apply on a case-by-case basis. So please go ahead and fill out the poll. And also, is there so you gave us, we put in there the website, the amicusplanners.com/2024. Is there another place that they can go to get more information, or is that a good place for them to start?
That's probably the best place to download that one-page guide, and then they can link back to our website from there. And then really, if they have any questions, you know, like this slide says about the traditional tax planning options, my partner Larry Peterson is kind of the guru there. He can answer all of those questions. If you have any questions about the contingency fee-based options, I'm happy to get on a call with anybody, talk through their specific questions, their, you know, specific situation, and kind of go from there. But yeah.
Great. Well, hey, I really appreciate the openness of that, and then bringing some really good info. I like the open-ended questions, so it's getting you to think differently, like a business owner. So really appreciate it, Greg. Can't wait till we do like something like this next time in the near future.
Yeah. Thanks. I didn't realize I was going that long. I just got going.
You're good, right? You're in it. I can tell you're in it. You're in
All
the
right.
zone.
Hey, thanks, Philip. I appreciate it.
Absolutely.
All right. Take care.
Okay. Bye, everyone.
Yeah. Bye-bye.